We are now recording this session from Talking Hedge Events, and I would like to bring in the CEO and founder of Talking Hedge Events, Meg Bodie. Meg?
CEO. Wow, I've never been called that before. Awesome. Hi, everybody, and welcome. I am extremely excited to bring you a crypto discussion this morning. A lot of attention here that we got over the past week that we've been marketing it, and really happy to see you all. Big attendance level and so much to get to. Just a fascinating prep call. I got so jazzed up. I couldn't wait till today. So here we are. Welcome. I hope everyone is healthy and safe. This is the 7th webinar in our series of 8. So next Friday will be our final one in this series, our spring series that is supplanting our trip to Austin. And then we're going to take 2 weeks off and let everybody have a super Memorial Day. And in early June, we're going to come back with our Toronto summer series, which obviously we can't get to Toronto. But anyway, I just want to say that the opinions expressed today by all of our speakers are their own, not necessarily the views of the companies for which they work. So please bear that in mind as you're listening. Like Ken said, the Q&A is there for you. We hope to get you involved in the discussion today, and we're going to run a poll quite early on to get some of your opinions and attitudes on this space. I want to thank our sponsors. Without our sponsors, we wouldn't be doing these webinars, starting with O'Brien Investment Group, which is the sponsor for today, and of course, including InnoCap, Managed Accounts, and InfraHedge, a division of State Street, and Lixor, a division of SocGen right now, but I think that's going to change. Right, Mark? I don't know if Mark is on. Bodie Research Group, Crable, Efficient, and we have Joe Mitchell today from Efficient on this discussion, Graham Capital, and Rowe Asset Management, and SLC Management, and Teza. And then, of course, our industry partners who we're so proud to partner with, our industry association partners, I should say, and those include AMA, CASA, and Kaya. So you've heard enough from me. Let's get moving. Chris, why don't you pop in? Chris, our moderator, Chris Stolars from Cliffwater, and John, come on in. Everybody pop on your cameras. And I am going to go away. Have a ball.
Well, thank you, Meg. Thanks to everyone for joining us, and welcome again to the Talking Hedge cryptocurrency panel, the first of 3 in the series. I'm delighted to be joined today by John O'Brien, Joe Mitchell, and Andrew Chen. John, would you mind giving a little introduction to yourself, your firm, and your interest in crypto? And you can start us off, please.
Sure, I'd love to. Thanks for everyone that put together, especially Meg, and to all the sponsors. I also want to say that the technical difficulties were on my end, so it was not Talking Hedge's fault. So I apologize about that. But my name's John O'Brien. I have a few different roles with our family, with my family. I'm on the board of directors at RJ O'Brien, our FCM. I'm on the investment team at our family office, and I run our family hedge fund called O'Brien Investment Group. In the last 3 years, or 4 or 5 years, all those roles have turned into crypto hats. So on the RJO side, we're onboarding institutions to trade CME, Bitcoin, and Ether futures. On the family office side, I'm spending 100% of my time now on opportunities in the digital asset space. So we're investing in venture directly. We trade derivatives. We invest in DeFi and operate in the DeFi space, yield farming and trading around alt cycles. And then on the O'Brien Investment Group, or OBIG for short, we added Bitcoin, CME, and Ether futures to our flagship quantitative global macro fund. We also launched a digital asset fund that just focuses on the crypto space.
Great. Thank you, John. In no particular order, Andrew, would you like to introduce yourself, your firm, and your interest in crypto?
Sure. Thanks for everyone for tuning in. Hopefully, we can keep you entertained. Grab some popcorn. My name is Andrew Chen, and I'm part of Lockheed Martin's corporate pension. Specifically part of the hedge fund allocation group there, and that's something I've been doing my entire career, really. And it was kind of by accident that I stumbled into crypto. maybe 3-ish years ago at this point, just kind of constantly hearing about it, but realizing that no one I knew had kind of an informed opinion on what was going on, and kind of from as an allocator, normally we can just call our managers for them to tell us what's going on, but this one, for whatever reason, I decided to dive in and kind of uncover what was happening underneath all of the buzz and, frankly, misinformation. And here I am 3 years later.
Great. It's great to have you. And Joe, last but not least.
Well, thank you. Great to be here. So I've been with Efficient Capital since 2004. I've had a couple of roles in that time. I've worked with our investment team and our business development team. And so currently I'm a portfolio analyst of digital assets, and I'm also the director of communication. So I'm constantly interfacing with those teams and helping them to communicate with our clients. I guess about 2 years ago, I got interested in crypto and kind of started my own personal research project, doing some reading. And I got really intrigued and started moving further. And so I started talking to some of my colleagues about that. And so we've been doing some research because we would like to know this space better. And there's just a lot of noise in this space. And so we've kind of really dug in to kind of find the signal in that. And we've done that by, talking with angel investors, vendors, managers, really trying to get to know the space, I think, from a bottom up kind of way.
Thank you, Joe. And my name is Chris Solars. I'm going to be the moderator today. I work at Cliffwater, which is an alternative investment consultant. We advise on around $80 billion across liquid and illiquid assets, from hedge funds to private assets. And I have been covering crypto now for a few years. I've probably seen 50 or so crypto hedge funds over the past few years. And I think my interest started a little more humbly. I'm still not a Bitcoin maximalist by any means, but I'm just intrigued by the possibility of disruption in old line industries, right? There's a crypto saying anything that can be decentralized will be decentralized. And there is just so much asymmetric opportunity in this asset class. It really can't be ignored. So that's kind of where I am today. And actually, my firm right now, I'm writing in the final stages of finishing a white paper. So we are going to publish something hopefully this month. So without further ado, I'd love to bring up the results of the poll, if we could, and that'll start us off. Let's see. So we have, okay, 2/3, 1/3 investor, a nice blend of classifications there. Somewhat. I think I would say I'm somewhat educated on crypto, so we're going to all get a little more educated today. That's great. So 43% are personally invested. And wow. So only 5% are professionally invested. This is a really, really important. This is exactly what I would have thought. I think very few institutional investors are invested, and this is where the big money is. I think this is where we see even further price rises when that really gets to 40% levels. What are the roadblocks? Well, so operational concern seems to be the biggest roadblock. We're going to talk about that. This is really interesting. Okay, so the fifth question: what would you be most comfortable investing in? We're comfortable investing in what we know in funds. So with that as a background, here's what I would love to do. I've really decided to break this discussion into two main parts. The first is a little background on perhaps getting to yes and getting comfortable on digital assets. Like, why is it so important? What are those roadblocks, institutional or otherwise? Is it volatility? Is it custody? Is it regulatory? We're going to talk about this. And then second, I want to dedicate a lot of time as well, which is really the topic of the day, is what is there beyond Bitcoin? What else is there in the beta space and the alpha space? And what would a diversified digital asset portfolio look like? So, wow. So I think if we set the stage just thinking about institutional crypto investments, I think 2017 probably was the first milestone when we had the CME and the CBOE Bitcoin futures. And that was 2017. 2018, we had Fidelity be the first major bank to offer cryptocurrency custody. But this year, when the Bank of New York Mellon in February of this year began financing Bitcoin or announced that they would start, I think this was really the starting point for institutional investment. And clearly on the corporate side, we have a number of corporates, MicroStrategy, Tesla, Square, that have billions of dollars of Bitcoin on their balance sheet. And we have a lot of investment banks like Goldman, Citigroup, Morgan Stanley, JP Morgan that have embraced digital assets. We've got ETFs in Canada, and we've got ETFs in Europe. We probably will have an ETF in the US within 12 to 24 months. And of course, Coinbase became the first major cryptocurrency company to list on a US public exchange. But this is really the starting point, I think. So I would love to get into perhaps some of the roadblocks for institutional investors. And John, maybe we can talk to you first, because you have done so much at your firm. You went up against opposition probably in the earlier days, and now you've embraced a lot of different lines of business in digital assets. Can you talk about some of your roadblocks and how you overcame them?
Yeah, for sure. I think since it's such a nascent asset class, it is really hard to for people that aren't in the space to understand the value of it. I kind of attacked it from, maybe I did it a little backwards. Most people, when they get in the space, they want to just buy Bitcoin and hold it. But our family background, when we come from the exchange world, brokerage world, the trading world, my great grandfather was one of the founding members of CME. So I kind of attacked it from that aspect. I wanted to extract the alpha out of the space before I wanted to talk the family office into just buying and holding Bitcoin. So I really started investing in the venture world, and again staying within my circle of competence. Again, being trading, exchanges, and brokerages. So we really kind of focused on the financial infrastructure in the space. There were really smart and talented people that were building great products. So we started actually in venture first. Secondly, we went into the trading side. Part of the holdup, and I can't remember what the percentage was from the poll we just did, but part of the holdup for a lot of investors is the custody and the security. So I started getting the family into trading derivatives at CME, since it's centrally cleared and there's no third-party wallet risk. And the theory there was that there is a lot of alpha in the space, just because it's a brand new asset class. There's not that many professional investors and money managers in the space. It's a secular bull market. I guess that can be debated, but very high volatility and a lot of inefficiencies, again, because it's such a new asset class. So I kind of attacked it from that perspective first. So investing in venture directly, trading it ourselves, and to kind of build a proof of concept that, yeah, there is a really good opportunity in this space. And it wasn't until then that the last thing we started doing as a family was building up our HODL position in Bitcoin, which stands for hold on for dear life, because of the volatility, like I just mentioned. And we kind of went about that in kind of a unique way. Instead of going to the market and just hitting the market with bids. Throughout the bear market, we were selling puts. And the idea there being, if Bitcoin went up, we collect the premium. Bitcoin went down, we collect the underlying collateral, being Bitcoins, which we wanted anyway, but plus the premium. So I think we wanted about it a little differently. Most people, they kind of like to dip their toes, but there's a lot of talented managers in both the hedge fund space and the crypto space operating in this industry. So it's my opinion that is the best way to get, especially if you're an institutional investor, to get exposure to the space, is to kind of invest in other people and learn how they do it. And you could do it in a parallel path where you're investing in managers that can extract alpha out of the space. You get to know the technology underlying Bitcoin, and then going out to Ethereum and the other smart contract platforms. So Bitcoin is Andrew called it this in our prep calls, so I got to give him props for this, but is the gateway drug. It's the crypto with the biggest network, the most liquidity. It's also the most simple to understand from a technology standpoint, since it's really just a protocol that transfers value from one wallet to another. So I think that's the best way to do it. Find some good venture funds, find some good hedge funds, and then learn how custody works, learn how digital wallets work, and get comfortable too with the volatility of Bitcoin, because it's a pretty wild ride.
Yeah, for sure. Well, thank you, John. Yeah, I think from my perspective, I think the way that you jumped in with the trading side is probably going to be the opposite that a lot of institutions are taking. Like you saw Mass Mutual, one of the oldest institution insurance companies in the whole country, bought just Bitcoin, right, for their general account. I feel like that's going to be the way that most institutions are getting, kind of the gateway drug, exactly. But there's certainly no wrong answer. Andrew, can you tell us a little of your institutional experience working on behalf of a corporate pension and getting into the digital asset class?
Well, I can't divulge state secrets, but perhaps I can, speak in general in terms of, going back to like what has helped, because as all of us on this panel, and anyone who has spent any time in the space knows, it's difficult to kind of, there is no quick elevator pitch. There's a lot of kind of background work that one has to do, and then when you speak to members of your investment team or investment committee or board or whatnot, I mean, they are not doing the same level of work that you might be. They are not listening to, hours upon hours upon hours of podcasts or, reading endless white papers, blogs, and just basically immersing yourself in this world. And unfortunately, it's just reality. We only have so many hours in the day. And, perhaps they're reading the Wall Street Journal, FT, New York Times, whatever. And to be very blunt about it, like those sources are pretty misinformed, about a lot of the arguments that they make. And so you sort of, I don't know if it's like Murray Gell-Mann effect is, you read something, you think that it's, that's official, but if you're actually in the space, you understand that there are gaps in the reporting. So anyways, trying to address a lot of the, reasons that come up and, custody, hacks, regulatory issues and stuff like that. Maybe quickly touch upon all those. I mean, maybe the punchiest is, I always hear, oh, well, they're just going to make it illegal. They're just going to ban it, and if you actually paid attention to what was happening, tangibly in the regulatory sphere, there's been actually surprising amount of progress. And, most notably the former acting OCC, Brian Brooks, made a lot of clarifications in terms of interpretations of regulations and the ability for banks to hold crypto on behalf of clients, and among other things. The latest one, this isn't official, but an interpretation by a former regulator that I spoke to, he pointed out that once you see regulators pivot from basically once they start addressing consumer protection issues, which you kind of heard of recently, that is a sign that they're moving forward on this, versus because if they're going to ban it, like why even worry about consumer protection? So there is movement in this way, and I don't think that you can just simply wave your hand and say we can ignore it, because of that, that's a tail risk. And, the other thing is like, even what does this do? Like a lot of it is, oh, well, I don't use Bitcoin to buy my coffee, so it's a waste of, what's going on. But I mean, there's a bigger conversation we could have about that. But maybe another thing that I've actually found recently, is that people are understanding Ethereum a little bit better, because of the range of things that you can do with that. And if you explain to us, it's a decentralized world computer, and you can build, financial transactions into that. And that is sort of the launch pad, for a lot of future innovation, or actually present innovation. I think people, especially in our world, because, markets and finance is naturally what we do. So I think that's surprisingly been something that's gotten a bit more take up lately.
Thank you. That's really helpful. Andrew is one of my go-to friends for crypto answers. So when he speaks, I listen. I think it would be really interesting. Maybe we could go through each of these roadblocks individually and talk a little bit about the comfort that we all have as crypto investors, getting comfortable with them. Maybe we could start with the biggest concern for the audience. They said operational concerns were 41% of concerns. So almost half the people are concerned about this. Joe, would you like to take that or start with that? Like, what do you feel?
Yeah. Again, like I said, just speaking from the research that we've done, we've spoken with traders, we've spoken with some investors, and I think that you were right in your summary earlier. The pre-2020 era custody was really an unknown, and one of the issues is that we're so used to working with large, well-established institutions. A lot of these custodians, they have 3 years history, 4-year history. So, I mean, that can be a big leap for an institutional investor. And that's, again, going back to what Andrew said about the innovation of the space. That's part of the excitement about it and why it's growing so much but that's also maybe one of the holdbacks for institutions is that we're not going to have all of the history or, an entire career in this. And so it does represent, some more risks that need to be taken a look at closely. And those are skills that we're all building towards. But as you also mentioned, Fidelity Digital Assets, a number of other firms are coming online with that. So I think we're going to see good custody solutions, and then people are going to become more familiar with decentralized markets, DeFis, and it's just going to be a new way of working, adding on to what we already know.
Yeah, that's right. I think with the trusted custodians getting into the crypto market, we're all collectively getting a lot more comfort. The second biggest roadblock, no intrinsic value. I remember, this is the I feel like this is the best argument against it in one sense. This is Charlie Munger's argument. It evolved out of nothing, and it still is nothing because you have a crypto digital asset that doesn't exist in the real world. So how can it have intrinsic value? I remember I had my aha moment. I was running in Central Park, listening to a crypto podcast, and it just made sense. I just saw how it can disrupt the current system of corporate finance, how it can disrupt payment systems, how it can disrupt the banking industry, how it can potentially disrupt the legal industry, real estate title, etc. It really, really made sense to me, and I just had this grand epiphany. I said, "Wow, that was it." But until people perhaps feel that same way, what do you tell them, John? How does crypto have an intrinsic value?
Well, I think the most important thing is that it's a $1 trillion asset, and it's achieved that network effect. And as long as I can send Bitcoin to someone in return for some other asset, then I believe that it does have intrinsic value. It's amazing how much better it is at moving money around the world than the current banking system is, going through SWIFT or going through ACH, FedWire. We're talking about FedWire or talking about ACH. It could take days sometimes to send money for settlement, and it's reversible to up to 2 years in some cases. Where sending money on a blockchain, it settles in minutes with finality. There's no reversing it. So it's just a much better way of moving money around the world. It's just what gives it value.
Yeah, one of the things that I really like about Bitcoin is there's this transfer of money, but it's kind of pure. It has its one thing that it's doing. And I think that's really helped to establish people. And, now it's been around for more than 10 years. It's established, it helps people to come into it, because when you start looking at things like Ethereum, which is where I had my aha moment, that was when, this DeFi thing, there are smart contracts, there are distributed apps. So on top of transferring money, now you can layer logic into when that's going to happen and how that's going to happen. And so that brings automation into banking. That was really my aha moment. And because once you do start going down that DeFi crypto hoods, it's different, it's new.
Andrew, a quarter of the respondents said that they had roadblocks at either counterparty risk or reputational risk. What would you say to that?
Well, I guess I'd have to ask in terms of, is it reputational risk of, oh, well, we invested in a crypto manager and I don't know, it went sour, so we look bad? Is that?
I think so. I would say that's
okay.
exactly what it is. Like your own reputation investing in this newfangled asset class.
Yeah. Well, I mean, if it was, maybe the blunt way to put it is if we were talking about, returning 4% a year, yeah, it wouldn't be worth it. But, the asymmetry of the space that's kind of why it's priced in. And I would argue that a lot of the reputational risk is unfounded because I feel like by the way, there are very real criticisms of the crypto space. They're very legitimate criticisms. And no one's saying that it is for sure, the end all be all. I think when you have maximalism or you have, tribalism in the space, it gets a little crazy. And unfortunately, those are the loudest voices out there. I think if you're able to be a little bit more objective and kind of look at it from, what is actually happening, you're basically rebuilding a brand new financial system from scratch that is decentralized and doesn't have gatekeepers and middlemen. Is that going to succeed? Who knows? But I would argue it's mispriced, and I think part of it is the reputational risk, if you will. It's just weird to go to, our events and go to cocktail parties and talk about magic internet money. But how stupid did the early internet founders seem in the previous cycles? So that is a risk, I guess. But I think if you do the work and you see what's happening, I think you'll appreciate that it's good to have a wall of worry to climb right now is maybe another way to put it.
Yeah. And I see, if DeFi becomes finance, and we dropped it, and it just simply morphs into what we consider finance, and this does become the future, perhaps reputational risk will be reversed. It will be those allocators that did invest are the ones that are still around, and the ones who didn't are the dinosaurs who are phased out.
Yeah, and that's actually one of the reasons why I decided to get into space. I mean, it really started with, okay, there's a great way to make money trading for ourselves and for clients. But it was also once I started learning the underlying technology, it was kind of like a ready, fire, aim approach. So yeah, we can trade it and then I'll figure out what it is later. And when I started digging into the underlying technology and Bitcoin, but mostly in Ethereum, you can have decentralized clearing on a blockchain. And it really made me start worrying about the future of RJO. So it kind of became a defensive strategy, kind of getting into the DeFi space and investing in these protocols and yield farming, and learning how decentralized finance works. And it's just evolved so quickly over the last 3 years.
John, what do you think are the most real concerns? If I had a crystal ball and I tell you in 5 years from now or 10 years from now, DeFi doesn't work out, Ethereum is worthless, Bitcoin is worthless. If I told you that, what do you think would be the reasons for it?
Wow, that's a really loaded question. Hopefully it doesn't go to zero. I do think about that. There's a non-zero chance it does go to zero, and that's why you have to size it in your portfolio accordingly. It's really just a simple bet sizing mechanism, just like you're putting on any other trade. It's really, really hyper volatile. So you just got to make sure that you have, you're not crying in your soup if it goes to zero. But there is a non-zero chance. I don't believe that that's going to happen. It doesn't keep me up at night. Bitcoin, people worry about a 51% on the Bitcoin network. I don't believe that's feasible. Getting all that hash rate and taking over the network and doing a double spend, the incentives aren't even aligned there. You would need an unbelievable amount of money to do it. And then what's the incentive to do it if you're just destroying the network anyway and it goes to zero? So, like I said, I don't believe it's going to zero. It's here to stay. It grows every day. It's achieved that network effect. I believe there's over $2 trillion now in assets in the space, and there are incredibly smart people building the future of finance. I don't know, Chris, if that answered your question, but I did the best I could.
No, thank you. That's really good. I think the environmental concern is a legitimate gripe. Joe or Andrew, what do you think? How would you respond to that? We've seen all the headlines that like Bitcoin consumption just for powering the network and miners for the whole year is the equivalent of a country like Argentina or Sweden, and it's using something like 0.5% of all energy in the whole world, and it will just continue to grow, right? As it becomes bigger and bigger and more used, it'll consume more energy.
Yeah, I mean, I can take a first crack at that. Yeah, I mean, everyone's seen that. That's always in the headlines. I think what gets misunderstood, perhaps, is you're not putting a Bitcoin mining facility in Midtown Manhattan or densely populated cities. Like if you're putting these things in Siberia, upstate New York, Washington State, Canada, and actually West Texas, and other places. And why I point out those places is because these are where a lot of stranded energy exists. So think of a dam that's overproducing in terms of energy for its local population. And the thing we found out with energy is it's not portable. So, Bitcoin miners migrate to wherever the cheapest source of energy is. And then West Texas is flaring. So, that's not to say that there aren't, Bitcoin miners that use dirty energy. There definitely exists, but, the mining is in a weird way, kind of like a very perfectly, like if you go back to, macroeconomics, perfectly competitive industry, very difficult, very much, ruthlessly focused on the bottom line. So, they're also, so by that tack, there's movements towards, if renewable energy can handle, mining, and that's the movement where a lot of these guys are going. And also a lot of mining is migrating to the United States. There is definitely a trend toward that. And, not to get into whataboutism, but, you're talking about the energy consumption of a full stack financial system. And I would argue, you got to look, if you looked at, what it costs to support the SwiftWire, Visa, MasterCard payments, all of that, all the data centers involved, it would probably be a pretty big number as well.
Yeah, I think I can add a couple points here. I guess first off, earlier in the year, Cambridge put out some research that said 39% of all Bitcoin mining comes from green energy, and this number is going up every day because this whole carbon footprint of the Bitcoin network does bug me a little bit. But I don't think the true story is really getting out there. So there's a lot of mining energy that does come from green energy. And to Andrew's point, that's very cheap form of energy that's kind of off grid. So you're seeing a lot of new miners pop up and take advantage of that. And Galaxy just released a very timely piece. I don't know if it was in response to Elon or not. But the article showed that the gold and banking industry consume 2 to 3x, I think it was, the energy that the Bitcoin network does. And if you think about it, it kind of makes sense, especially with the banks, with all the data centers they're running, the bank branches, ATMs, the private jets that their C-suite employees fly around on. But with regards to Elon specifically, this is very timely for our panel. And crypto Twitter's been trying to figure out what he's up to. There's no way Elon bought $1 billion worth of Bitcoin without knowing about the environmental impact argument. I think it's pretty safe to say he's a very smart guy and does his due diligence. He's also a very volatile guy. He'll tweet about Tesla being overvalued and tank the stock 10%. But he's also a master marketer. So if he truly is a Bitcoiner, or a crypto or whatever you want to call it, he's obviously a green energy guy because of Tesla. there's an amazing opportunity here for him to tie Bitcoin mining and Tesla together. He's literally putting solar panels on rooftops. So if he connects the two, instead of Tesla smart homes selling excess energy back to the grid, individuals could contribute clean energy to Bitcoin mining. I think it's a massive opportunity for him. I think he's realizing it. I don't know. It's purely speculation. Obviously, we're seeing in crypto Twitter, and obviously they're going to defend Bitcoin and the network until the day they die. But certainly, the carbon footprint of Bitcoin is a little troubling. But I feel like I keep repeating myself. But there's really smart people in the space that are solving this problem too.
Yeah, sure. Just to add a little bit into that, it feels like a little bit of isolating Bitcoin too, right? I appreciated, John, you said, well, the entire banking industry. I just think about the entertainment industry itself, YouTube, how much does it cost to render a movie? So I think there's a lot of things that it's just isolating. And so it's easy to kind of pick on it when you isolate it. But where are we valuing our energy consumption? I think it's a part of the larger conversation.
Yeah. And, I saw a nice creative solution for institutional investors by One River, where they give you a beta for cheap. I think it's 75 basis points. And they offset that with carbon credits. So you're able to buy a kind of carbon neutral Bitcoin investment. And it's only, it's less than 1% to offset it. So you're effectively getting all the upside and, perhaps all the downside, but it's a carbon neutral Bitcoin investment. I thought that was a nice solution to this conundrum. I want to move into the second part of my questions for the panelists. And really, if we move beyond just Bitcoin or just buy and hold, can we talk more about the whole spectrum of digital assets? And as I think about it, you have obviously your beta. It's highly liquid. If you start with the top two digital assets, or really the top 5 or 10 are quite liquid. You can have daily liquidity and a lot of them are in fund format. You can get easy access to this. And then all the way out, you have 10-year VC money where you're locking yourself up. And perhaps I've always thought that for longer term lockups like this, you're really protecting yourself from yourself, right? It's a risk management so that you don't pull the trigger at a low because you did want to invest for 10 years. That's why you invested for that long. And then we have everything in between. We have like coin pickers now. We've got a lot of different ARBs, a lot of different market neutral type managers as well. So maybe we'll start with you, Joe. I know you've seen a lot of different managers. Could you tell us like some of the interesting things you've seen in the crypto space besides just the buy and hold?
Yeah, sure. Again, talking to managers, one of the great resources that we ran across in this, and that's one of the things I want to emphasize. One of the things that's great about the crypto space is people are very open and transparent and really willing to connect you to other people. And through that, we met a group called Vision Hill out of New York. Part of their work is they maintain a database. And that was another moment that I was a little bit surprised by. Inside their database, they have about 450 VC funds and about 400 crypto-focused hedge funds. So that was a wide opening. Wow, there are a lot of people moving into this space and, managing money specifically here. And to your point, all those strategies are there. At Efficient, we tend to look at more active alpha strategies. So we've been more focused in looking for momentum and trend strategies, which they're there. But also we've had the opportunity to talk with people who have more macro. One of the things that's interesting about crypto is VC, hedge fund, it all kinds of gets mixed together because it's still emerging. So you'll have people who are trading around themes around coins that are associated with gaming. And so the whole alt coin space. So there are a lot of themes. Macro, there's a lot of good data that happens in the quant space. And I guess, just kind of wrap things up, you tend to think talking about it in more quant terms, but it's a lot like FX because we have different exchanges. We have more centralized exchanges. We have decentralized exchanges. We have, cash futures. If you're outside of the U.S., there's also perpetual futures contracts. So there's a lot happening. People I don't know are really aware that there are all of the standard financial instruments you would expect, plus more in the space.
Yeah, thank you. John, can you tell us about all the different products, maybe the different products that you guys are running much above and beyond passive investing?
Yeah. So yeah, outside of venture, that's an obvious one. It's easy to stick into one bucket. There's a lot of different things you can do in this space, and we've seen some managers too. A lot of different managers doing a lot of different things. They're kind of like snowflakes in that regard, and it's a great opportunity for institutional investors to put portfolios together, because you have all these different managers doing different things, which means they have different return profiles. Some correlate to each other and some not. But it's a great.
John, maybe I can point out to the audience, I think the reason venture was so popular with ENFs and with early institutional adopters is because they were investing in a traditional business model. Like you're investing in Coinbase, in the equity of Coinbase, which is related to digital. You're getting all the upside, but you don't have perhaps the strange sensation of investing in digital tokens. And I think perhaps that's why venture had really took off to be the first asset class, even though you might think that the longer lockup would be more a latter entry, right?
Yeah, and I think too, the reason venture took off so quickly is typically the investors in venture and the people that have venture funds are more tech savvy, I would say, or more focused on the tech side. And that's really what this is. It's a new technology that's trying to disrupt finance as we know it. But I mean, even just us as a family, between our family balance sheet and the fund, we're doing a lot of different things. I could probably talk more specifically one-on-one with people, but I think broadly, we have that buy and hold. Like I mentioned, we're doing some arbitrage strategies, especially with the basis trade at CME, and looking to do it offshore as well. There used to be a grayscale arb that we were somewhat doing. Grayscale was trading at a premium to actually NAV, and there's a way that you could sub into it at NAV with Bitcoin, sit through the lockup period and sell it at a premium, but that trade is gone. And I think it's probably important to just the importance of having a malleable strategy, because the industry is changing so quickly. We have directional long or short strategies and derivatives. Some of these are legacy trend following models and machine learning models that we've built out recently that are trading these derivatives, but we also trade it from a discretionary standpoint too, so we can be quite tactical. Like I said, we were building a hodl position with short options, but we also trade options around our current book. So covered options, the implied volatility is so high, you don't have to write that many to get a big return. So that's another opportunity, especially as options onshore. They're not quite as liquid as offshore. As Joe was mentioning, these offshore derivative exchanges, the majority of the volume is still offshore. But I think you're seeing, especially the Justice Department coming after Binance recently. I think a lot of that institutional business will start coming onshore in a regulated way. So we're also looking to make markets and hash rate. So essentially getting even closer to the underlying network by providing liquidity to miners, so they can lay off their hash rates, raise US dollar, buy more equipment. So there's two ways you can make markets now for miners: the hash rate and also buying their Bitcoin after they mine it. So there's just so many different things you can do in this space to extract alpha. And we've seen the funds that we've met with doing some of these, doing all of them. It's really a mishmash.
And John, what are the platforms that are supporting Bitcoin options trading? What are the biggest platforms around the world?
So the biggest one is offshore, unfortunately, and they KYC, so you have to have an onshore entity, and you got to do it the right way too. It's called Deribit, so offshore derivative exchange. The interesting thing about trading offshore, and unfortunately trading onshore here, we're trading with a little bit of a handicap. But offshore, you can put up Bitcoin for collateral. for margin trading, whether that be an option on Bitcoin or a futures or perpetual swap that Joe mentioned. It's just it's a great way to monetize your current Bitcoin. So we have some challenges onshore, trading that, because there's no way to post your Bitcoin for collateral, and it is somewhat of an issue, especially for the commercial hedging industry. They want to hedge their risk, but they're Bitcoin rich and US dollar poor, and they can only post their US dollar for collateral for margin purposes to hedge their risk. So a lot of the business is offshore, but like I said, you're seeing US regulators go after these businesses. They went after BitMEX late last year. They just went after Binance. Binance, I believe, is the biggest offshore futures crypto exchange by notional value and volume. So there's just an interesting dichotomy between onshore and offshore.
Thank you. Andrew, maybe I could jump to you and ask, just in general, how should institutional investors allocate to this space? Like, what is your recommendation in terms of perhaps the percent of the balance sheet and how they should start and what they should be thinking about as they grow their digital asset allocation?
Ooh, okay. So again, with the premise that this is not investment advice, because we're talking about something that's pretty nascent and disruptive. I mean, maybe to piggyback off of our colleague Marcos Veramis, who wrote the white paper at Cambridge 2 years ago, Cambridge Associates. He was recommending that at the time the clients he was speaking to were allocating something around, I think, 10 bips, 20 bips to the space. It was like no more than one. And so that's where, and the clients he was speaking to were from the institutional set. So I might just kind of copy and paste that answer. But before, I think it's vital to have some exposure, but I also understand that it's a very weird thing to do. So, I mean, I guess I would view this somewhat in terms of option like risk reward, and kind of appreciate that one. I think that's why a lot of the allocations that I've heard from other institutions have gone into the venture bucket, just because it kind of shares that risk return. But yeah, I think John and Joe covered a lot of the other things that you could do, so I don't necessarily need to reinvent the wheel there. But I do want to make a point. This is coming to allocators whether they like it or not. I don't know if anyone saw the headlines this week, but SAC, Point72, that is the artist formerly known as SAC, Millennium, and Matrix are publicly getting involved. Maybe a month ago, you saw Brevin Howard, who Alan Howard's been a long time supporter of the space. They're putting it in their main fund, and obviously Paul Tudor Jones last year. And I think I can say Third Point is doing stuff in the space. And by the way, this is not just buying Bitcoin. This is going beyond and into the token space. So it's coming for us.
Yeah. And I think you had a great point about VC in the sense that I think we all are handicapping this, that this is going to be big, but it might not, right? And maybe my confidence level is high, but you take the expected value of your prediction multiplied by the upside there. And if you think about it as a VC investment, we know in VC you could lose everything, or you might go up 10x. And I feel like that, at least for the beta here, that is the investment. And where else can you get this type of upside in this zero interest rate environment where we have negative real rates in corporate bonds? This seems to be a disruptive technology that, when I think personally about the brain drain that I've seen of friends who've left for crypto, some of the smartest, most cutting edge hedge funds started to do crypto, and on the technology side as well. You hear about programmers leaving Google and leaving some of the big tech firms to go work at crypto. It's real. It's happening. And I think probably when the ETF comes, that the true announcement of the arrival of the institutionalization of crypto will be when the SEC approves an ETF. And I hear that they're probably going to approve many at once so as not to favor one over the other. So probably from one day to the next, we're going to see big headlines that you can finally, through your regular brokerage account, invest in 8 different crypto ETFs, and then it will be off to the races. So, I think we're still in the early innings here, but I like how you said it, Andrew. It's coming for us whether we like it or not. We're getting close to the top of the hour, and I wanted to end, if you guys would humor me, with a figurative gun to your head. Can I ask you 2 questions? What is your year-end prediction price for the dollar value of Bitcoin? Number 1. And number 2, what is your favorite altcoin investment? So hopefully we can just go around the horn really quickly here. John?
I love this price question. And I'm going to sound like a psycho person, but like mathematically, Bitcoin can go to infinity because the asset that it's denominated in US dollars seemingly has unlimited supply. Having said that, it does trade around the halving, so it's kind of a fun exercise to see what the price will be post halving or at the end of the year. I certainly think it's going to be higher than it is today. I think I'm going to sound like a psycho person again, but it's at least 100,000 a year end, but that might be after the peak as well. And my favorite altcoin. I've never been asked this question before, and we're not going to talk our book, but I think the most fun to watch is Dogecoin because it really shows the power of the network and the people in the space that like a meme coin, a joke coin can actually accrue value. I think, though, I should probably say Ethereum. It's a really good proxy for the entire DeFi space. It's being built on Ethereum, so I got to stick with Ethereum because it's the biggest one. It's the biggest altcoin, and it's a good place to start if you're just getting in the space. Yeah,
good. Thank you, John. Joe?
Well, I'm really not in the prediction game. This one's tough for me. I think there's going to be a lot of volatility this year. I mean, well, clearly, but we've seen some big moves from institutions, which I think is maybe slowing things down a little bit. So I could see Bitcoin continuing up, but I don't think that it'll double. Again, I'm way more interested in what's happening in the DeFi space because I think that it has so much capacity to go because you can use Bitcoin in the DeFi space and yield farming and all these other pieces. So I think that it probably has further to go. And again, I like Ethereum too, because right now so much is the backbone of what's happening in the DeFi space.
Yeah. Thank you. Andrew?
Oh, man. Yes. Similar disclaimers as the rest of the panel. But let's go nuts. I'll say 150 for Bitcoin. ETH is definitely a good thing to look at, but let me take it slightly in a completely different direction. If you really want to dive down something that is truly of the crypto ethos, look at Rune, Thorchain, RUNE.
Thank you. I think I'm going to take the under, right? I'm going to take Bitcoin 25,000. I think what's interesting is you see the highs are higher than the last time, but also the lows are higher as well, right? And we've had so much speculation. I think at some point we're going to see a big pullback. And I heard on the Bloomberg podcast, they had the SocGen analyst talking about the next finance crisis will be started from cryptocurrencies. And you see the overlay of everyone there's so much, because it's decentralized, right? We don't know where the leverage lies. And because some people who invested in Bitcoin are also invested in Tesla, and Tesla's invested in Bitcoin. And once you see that domino effect fall, it could get really nasty, right? And I think for me, DeFi is very exciting. I saw that Bitwise and Galaxy now have top 10 DeFi indices. And after looking at hedge funds for all these years and talking to so many analysts about their top picks, I'm hesitant to pick even one, but I think you can feel confident with the top 10, index, that I think that will have a lot of value in the future. So I want to say thank you to everyone from calling in from all around the world. I know we had 28 different countries represented in our audience today, and I'm going to turn it back to Meg. So have a great weekend, everyone.
I feel like that emoji, like an exploding mind. You guys really lit it up. I mean, there is so much packed into that. It's unbelievable. And if this was sort of the start, because we're going to do 3 of these with you, right, John? If this was number 1, everybody stay tuned, because this summer, probably in late June or early July, we'll announce the next one and we'll bring you, even a deeper dive. That was amazing. Thank you so much for your participation. Each of you gave so much opinion and just great background and information. And thank you all for tuning in. We'll see you next week, I hope. Take care.